Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Antero Midstream Corporation Annual Report. Antero Midstream Corporation provides a range of businesses and services that cater to the midstream energy sector in the Appalachian Basin. At its core, the company operates in three key segments: gathering and processing, water handling, and other related services. The gathering and processing segment is responsible for collecting and processing natural gas and NGLs from Antero Resources wells in West Virginia and Ohio. This includes a network of gathering pipelines, compressor stations, and processing and fractionation plants that enable the efficient transportation and processing of these energy resources. In addition to its core services, Antero Midstream Corporation also offers water handling services. This segment delivers water from various sources, including the Ohio River, local reservoirs, and regional waterways. The company uses advanced water handling systems to transport flowback and produced water, providing a critical service for the oil and gas industry. Overall, Antero Midstream Corporation's diverse range of businesses and services make it a key player in the midstream energy sector, supporting the operations of Antero Resources and other companies in the region. The significant increase in Antero Midstream Corp's stock price over the past year can be attributed to several key events that showcase the company's financial strength and strategic growth initiatives. One of the primary drivers was the robust Q2 2025 financial results, which highlighted an 11% year-over-year increase in EBITDA and a substantial 90% surge in free cash flow after dividends. This demonstrated operational efficiency and a positive outlook for the company. Additionally, Antero Midstream reduced its capital budget and raised its 2025 adjusted EBITDA guidance, further solidifying investor confidence. The announcement of a Q4 2025 dividend declaration and share repurchase program also contributed to the stock price increase. The company's commitment to returning capital to shareholders through dividends and share buybacks sent a positive signal to investors, indicating that management is focused on creating value for stakeholders. Furthermore, Antero Midstream's Q4 2025 results and strong 2026 guidance provided additional momentum to the stock price. The company reported a 5% increase in low-pressure gathering and compression volumes, a 4% rise in adjusted EBITDA, and $86 million in adjusted free cash flow after dividends for Q4 2025. For 2026, Antero Midstream projected significant growth, including a 23% increase in net income and an 8% increase in adjusted EBITDA compared to 2025. The acquisition of HG Midstream in early February 2026 also played a crucial role in driving the stock price upward. This strategic move is expected to contribute to Antero Midstream's growth in 2026 and beyond, particularly with the integration of water systems and incremental water services in 2027. Overall, these positive financial reports, coupled with shareholder-friendly actions and strategic acquisitions, collectively contributed to the upward momentum in Antero Midstream Corp's stock price, leading to increases exceeding 27.91% within the last year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for Antero Resources can be categorized into several key areas. Revenue growth is primarily driven by increased throughput volumes and higher gathering and processing revenues. Additionally, changes in working capital and decreased costs associated with gathering systems and facilities have also contributed to revenue growth. Furthermore, the impact of commodity prices on Antero Resources operations has been a significant factor in revenue growth. On the other hand, revenue decline is primarily driven by increased state regulation, changes in hydraulic fracturing regulations, and decreased revenue from gathering systems and facilities. The potential decrease in FERC regulation could also lead to an increase in revenue, but this is not yet a realized effect. Other factors that may impact revenue growth or decline include customer concentration, risk factors, the success of the HG acquisition, the completion of the Utica Shale divestiture, and the performance of the joint venture with MarkWest. These factors can have both positive and negative effects on Antero Resources' revenue. The net income of the company experienced a significant fluctuation between 2024 and 2025. Initially, it decreased by $346,000, $526 from 2024 to 2025, but then increased to $413,163 in 2025. This inconsistency suggests that various factors contributed to the change. A closer examination reveals that profit margins also underwent a decline of 46.7% between 2024 and 2025, dropping from 0.677% to 0.362%. However, operating profit margin showed an improvement in 2025, reaching 54.3%, although the figure for 2024 was not provided. The reasons behind these changes are multifaceted and complex. Material shut-in of production by Antero Resources, decrease in volumes of natural gas produced, and increase in costs of equipment and materials used in construction were some of the key factors contributing to the decline in net income and profit margins. Additionally, increased costs for environmental compliance and remediation, capital expenditures, and exposure to commodity price risk also played a role. The Inflation Reduction Act, IRA 2022, imposed new costs on operations and reduced demand for oil and gas, further exacerbating the situation. The uncertainty surrounding future regulatory changes under the Trump administration or Congress added to the complexity of the issue. Overall, the decline in net income and profit margins can be attributed to a combination of these factors, which collectively impacted the company's financial performance. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the net cash provided by operating activities has increased substantially over the past year. In 2024, the company generated $843,994,000 in positive operating cash flow, and this figure rose to $932,464,000 in 2025. This trend indicates that the company is successfully managing its day-to-day operations, generating sufficient cash to meet its financial obligations and invest in growth initiatives. The increase in operating cash flow suggests that the company's business model is becoming more efficient, allowing it to convert profits into cash at a higher rate. This positive development bodes well for the company's long-term sustainability and ability to continue investing in its future growth prospects. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, on page 55, it was reported that interest expense decreased by $17 million from $207,027 in 2024 to $0 in 2025. This indicates a substantial reduction in interest expenses. Further analysis reveals that this trend continues, with interest expense decreasing by 8% from $207 million in 2024 to $190 million in 2025 on page 58. However, the most striking change is noted on page 62, where it is stated that as of December 31, 2025, there were no outstanding borrowings or letters of credit under the credit facility, resulting in zero interest expenses. This suggests a significant reduction in debt level and interest expenses, indicating a positive financial trend for the company. Management at Antero Midstream Corporation is optimistic about the company's outlook and strategy for 2026. A key aspect of this plan is prioritizing capital efficiency by reusing or repurposing assets, as evident from their $190-220 million capital budget. This approach will enable the company to allocate resources effectively while minimizing waste. The company also aims to reduce its debt burden by using net proceeds from the Utica Shale divestiture to repay long-term debt. Furthermore, management is committed to mitigating commodity price exposure through fixed fee or cost of service fee opportunities with Antero Resources and third parties. In terms of financial performance, the company has reported steady operating income in 2024 and 2025, with total assets increasing over this period. Management's focus on providing high-quality services to customers, such as Antero Resources, is expected to drive growth and profitability. The company plans to return capital to shareholders through dividends and share repurchases, which may limit its ability to expand through acquisitions. Overall, management's strategy emphasizes prudent financial management, efficient use of resources, and a commitment to delivering value to customers and shareholders. The company has made several strategic acquisitions to expand its operations. One notable acquisition is the HG acquisition, which involved a $1.1 billion cash consideration for gathering pipelines and integrated water handling assets in West Virginia. Additionally, the company acquired approximately 385,000 net acres in the core of the Marcellus Shale in West Virginia through the HG Upstream acquisition. The company also acquired assets from Crestwood Equity Partners LP, EnLink Midstream LLC, and Summit, including a Marcellus Gathering and Compression Agreement, Utica Compression Agreement, and Mountaineer Gathering and Compression Agreement. Furthermore, Antero Resources' acquisition of additional acreage was also noted. On the other hand, the company has made divestitures to streamline its operations. The most significant divestiture is the sale of substantially all of its Utica Shale property and equipment in Ohio for an aggregate cash consideration of $400 million. This move suggests that the company is focusing on its core assets and reducing its presence in other areas. The company has a history of paying dividends to its shareholders. In fact, it paid out a dividend on common stock of $0 and 225 cents per share in February 2026. Additionally, during the year ended December 31, 2025, the company paid a total of $439 million in dividends to holders of common stock at a rate of $0.90 per share. In terms of share buybacks, the company has also been active in this area. In a specific program, it repurchased approximately 8 million shares for a total cost of $135 million, with $336 million remaining under the program. This indicates that the company is committed to returning value to its shareholders through both dividend payments and strategic share purchases. Concerns about supply chain disruption exist. The possibility of supply chain disruption is a pressing concern in various industries. One major issue is the availability of essential materials such as steel, which can lead to construction cost overruns. Furthermore, disruptions in the supply of gas and power are also potential risks, particularly for processing and fractionation plants that rely on these resources. Additionally, global trade dynamics pose another threat to supply chains. Trade sanctions, tariffs, and conflicts can significantly impact businesses by disrupting their ability to access necessary materials and resources. These disruptions can have far-reaching consequences, affecting not only the affected companies, but also the broader economy. That concludes the financial summary for Antero Midstream Corporation. Feel free to comment below, and I will be happy to answer them when possible.